The annual deficit in America is at its historical high at $3.1 trillion. Are you tired of seeing your hard-earned savings get wiped out due to excessive money printing by the Federal Reserve? Do you feel that the prices of goods are soaring while your savings is diminishing? Well, you're not alone. The USA's senseless money printing is killing your savings, and it's time to face the ugly truth. Welcome to today's video, where we'll discuss the harsh reality of the USA's senseless money printing and how it's affecting your savings. Inflation rates are at a historical high in the last 40 years, with the current rate at 5.4%. This means that the purchasing power of your dollar is losing value. Your savings are decreasing in value daily, all due to the government's overspending and excessive printing of money.
What's happening to the almighty U.S. dollar?
The American dollar is losing friends.
We must protect the position of the American dollar as a pillar of monetary stability around the world.
Inflation is the rate at which the general price level of goods and services in an economy increases over time. For example, let's say you have $100 to spend today and you can buy 10 apples for $10, meaning 10 apples now cost $10.50. If your income has not increased by 5%, you can no longer buy the same number of apples you could before. This is why inflation reduces the purchasing power of your money over time, and as we have mentioned before, inflation is a direct result of the government's overspending and the Federal Reserve printing money out of thin air. Inflation in the United States has been on the rise, increasing from 3.2% in 2011 to 8.3% in 2022. The U.S. Consumer Price Index, CPI, was 285.84 in 2020 and is predicted to reach 325.6 by 2027. In December 2022, there was a monthly increase of 0.4% in the CPI for urban consumers in the U.S. compared to the previous month. This increase in inflation on the dollar is driving many countries worldwide to higher inflation rates due to the dollar being the world reserve currency. The Federal Reserve is the central banking system of the United States, created in 1913 to provide a stable financial system and promote economic growth. Its main purpose is to regulate monetary policy, supervise and regulate banks, and maintain the financial system's stability. The Federal Reserve is responsible for managing the money supply and interest rates in the economy and works to ensure that the economy remains stable and healthy. The Federal Reserve lends money to banks through its discount window. Banks can borrow money from the Federal Reserve at a low interest rate and use it to make loans to businesses and individuals. This helps ensure that banks have enough money to lend to people and businesses, even during economic uncertainty. Banks, in turn, lend money to individuals and businesses through loans and credit. When you apply for a loan or credit, the bank evaluates your creditworthiness and ability to repay the loan. If you are approved, the bank will lend you the money and charge you interest on the loan, which is how they make money. The Federal Reserve is crucial in regulating the economy and ensuring its stability. Let's dive into interest rates. Interest rates are the rates at which lenders charge borrowers for using their money. Let's say you want to borrow $1,000 to buy a new laptop, and the interest rate is 5%. You must pay back the $1,000 plus an additional $50 interest charge. If the interest rate increases to 7%, you must pay back $1,070. Higher interest rates mean borrowing money becomes more expensive, deterring people from borrowing and spending money within the economy, causing an imbalance of supply and demand. These characteristics and misuse of government spending drive the economy into a recession with higher unemployment rates. In return, the Federal Reserve attempts to curb the inflation by hiking the interest rates. Lowering interest rates is a common monetary policy tool the Federal Reserve uses to stimulate economic growth. This is also known as quantitative easing. As part of the government's quantitative easing monetary strategy, a central bank buys assets off the market in an effort to expand the money supply and bring down interest rates. This makes borrowing money from banks simpler for consumers and businesses. In order to credit the reserves of the banks that sell the assets, the central bank creates fresh money. The banks can then extend more loans at competitive interest rates. When the Federal Reserve lowers interest rates, borrowing becomes cheaper, encouraging consumers and businesses to take out loans and invest in the economy. Lower interest rates can also benefit savers and investors by increasing their purchasing power. When interest rates are low, people can borrow more money at a lower cost, increasing spending and investment in the economy. This, in turn, can stimulate economic growth and create new job opportunities. In addition, lower interest rates can make it easier for people to pay off their existing debts, as the cost of borrowing is reduced. This can help stimulate consumer spending, a key driver of economic growth. However, in America's particular situation, it is important to note that lower interest rates can also have negative consequences. For example, if interest rates remain low for an extended period, this can lead to inflation as consumers and businesses have more money to spend.
Reserve is raising the
Fed
interest
is
rate
set to raise interest rates.
Highest inflation in 40 years.
Inflation can erode the value of savings and reduce the currency's purchasing power, which can negatively impact the economy in the long term. The business cycle has 4 phases, and the first one is called the expansion phase. This means the economy is growing and a healthy inflation rate is 2%. The Federal Reserve, or the Fed, finds this as progressive. In August 2020, the Fed said it would allow inflation rates higher than 2% if that would help create more jobs. They still want a 2% inflation rate in the long run, but are willing to accept higher rates if inflation has been low for a while. Although you are now seeing historical rates. When the economy grows more than 3%, it can create a problem called an asset bubble. This happens when the market value of an asset, like stocks or real estate, goes up much faster than its real value. After the expansion phase, the market starts resisting higher prices, leading to the third phase, the contraction phase. The growth rate becomes negative, and if it goes on for a long time, it can cause a recession. During a recession, deflation can happen, which means that the prices of goods and services start decreasing. This can be more dangerous than inflation. Disinflation is usually the result of an overly inflated economy. Eventually, the economy reaches the lowest point, called the trough, and starts to recover. This marks the beginning of the fourth phase, where the expansion starts again and the inflation rate increases again. This cycle repeats itself. During recessions and troughs, the Federal Reserve, or the Fed, attempts to use monetary policy to control inflation, deflation, and disinflation that ultimately still results in the diminishing of your savings. The government spends money on various programs and services, including defense, social security, healthcare, education, and infrastructure. To fund these programs, the government collects taxes from individuals and businesses. However, if the government spends more than it collects in taxes, it will run a budget deficit, meaning it must borrow money to finance its spending. The government can borrow money by issuing bonds, which are essentially IOUs that are sold to investors. These bonds pay interest to investors over a set period and are typically considered a safe investment. However, when the government borrows too much money, it can lead to higher interest rates and inflation, as there is more demand for borrowing and less supply of available funds. In addition to borrowing money, the government can print more money to finance its spending. This increases the money supply, which can lead to inflation and a decrease in the value of the currency. So the question is, how the U.S. can excessively print money and how it will affect the world and their savings. The U.S. economy is not immune to money printing, but it has the privilege of being the world's reserve currency. As such, it can print more money without causing an immediate decrease in the dollar's value. However, excessive printing can lead to inflation, which reduces the currency's value over time. This inflationary pressure can spill over into other countries, especially those that rely on the U.S. dollar as a reserve currency. When the U.S. prints more money out of thin air, it causes the dollar's value decreases, making imported goods more expensive. The dark truth about excessive printing is that it leads to a devaluation of the currency, which in turn leads to a decrease in the purchasing power of the people using that currency. In 2020 alone, the U.S. printed 35% of all the currency it has ever made, which is alarming. The more money printed out of thin air, the higher the inflation rate increases, decreasing the dollar's value. Ultimately, excessive money printing kills the global economy and the U.S. economy, making people unable to afford as much, shifting the consumer from a buyer's class to a renter's class. The U.S. economy's ability to withstand the effects of money printing is largely due to the U.S. dollar's status as the world's reserve currency. Despite concerns about inflation and the dollar devaluation, the U.S. government has continued to print money to fund various initiatives and stimulate the economy. However, it's essential to remember that excessive money printing can have significant consequences in the U.S. and the global economy. As investors lose confidence in the dollar's value, other countries may look for alternative reserve currencies, leading to economic instability. Therefore, while the U.S. dollar's reserve status provides some cushion against the negative effects of money printing, policymakers need to exercise caution when printing money and consider the long-term consequences of their actions. As we have now seen China, Russia, and India pulling out of the world reserve currency due to the careless nature of the Federal Reserve. Who is next? That's it for today. Don't forget to like, share, and subscribe to our channel for more exciting content. Thank you for watching.